Customer lifetime value, CLV. Customer will spend from the time of acquisition to termination of the relationship with the company. Customer lifetime value, CLV, sometimes referred to as life value, LTV, is the margin that a company expects to earn for all business relationships with an average customer. Customer lifetime value, CLV, is a financial metric used to study a customer's profitability and, when properly calculated, the potential impact on various marketing efforts throughout the customer's lifecycle. Customer lifetime value, CLV or CLTV, is a measure of the total revenue a company can reasonably earn from a single customer over the course of a business relationship. Customer lifetime value, or lifetime value, LTV, is the average amount your customers will spend on your business over the life of your relationship. In marketing, customer lifetime value, CLV or usually CLTV, customer lifetime value, LCV, or lifetime value, LTV, is a forecast of net profit contributed by all future customer relationships. How to calculate CLV? To calculate customer lifetime value, you need to calculate the average cost per purchase and then multiply that number by the average number of purchases to determine customer value. When measuring CLV, it is best to take into account the average total revenue generated by a customer and the average total profit. In either case, you need to know the average rate of return on purchases, the amount you spend on acquiring a customer, customer acquisition cost, and the duration of the relationship with the customer. For example, to calculate CLV, an entrepreneur must estimate the value of the average sale, the average number of transactions, and the duration of the business relationship with a particular customer. The problem with calculating CLV this way is that it comes from a global perspective, customer base, and it's hard to use it to calculate CLV value at a micro level, like in a marketing plan. The calculation may result in CLV being a multiple of the actual CLV, and must instead be calculated as all of the net income expected by the client. The most accurate CLV forecasts are made using the net present value, NPV, of each future source of net income, so that the income that will be received by the customer in the future is recognized at the future value of money. Predictive CLV is based on the history of past transactions and customer actions to better predict the value that a particular customer can create. Using the CLV predictive model will help you better identify your most valuable customers, the product or service that generates the most sales, and how you can improve customer retention. Using CLV information, you can identify existing and potential high-value customers and customize your marketing to uniquely match their message, offer, and channel. You'll also learn which acquisition channels bring in the most valuable customers, and you'll be able to replicate the strategies you use to find them. With this knowledge, you can develop a customer acquisition strategy that targets the customers who will spend the most on your business. Once you've done a CLV analysis for all of your current customers, you'll know how much it makes sense to spend on acquisition. This means using effective methods to get your current customers to buy more, whether through discounts or upgrade coupons. Don't just look at new sales and completely ignore existing customer behavior. Finding new customers is still important to the growth of many companies, but optimizing the lifetime value of existing customers is also important for a company to maintain a sustainable business model. We recommend using CLV to create value across the entire customer lifecycle. CLV is an important metric because it gives you a customer-centric perspective to manage some of the important marketing and sales strategies of your subscription business, such as acquisition, retention, cross-sells, upsells, and support. Your company's average CLV is an important metric to track because it helps you set KPIs based on overall performance. The metric looks at the value of a customer's income and compares that number to the customer's life expectancy. Following the steps listed above, we can use the data from the Kissmetrics report to calculate the average lifetime value of Starbucks customers. Customer lifetime value considers the investment we plan to make for our customers, retention, sales, promotions, customer service, etc., and the return we expect to receive from them. Customer lifetime value tells you how much you can earn from your customers over the course of a partnership. It helps you understand how much you can spend to attract new customers, how long it will take to get a return, and whether you are a customer relationship why them profitable in the long run. Customer lifetime value has intuitive appeal as a marketing concept because it theoretically represents exactly how much each customer is worth in monetary terms, and therefore how much marketing should be willing to spend to acquire each customer, especially in response marketing middle. Straight. It's hard to predict how long a relationship will last, but marketers can make accurate estimates and list customer lifetime value, or CLTV, as a recurring value. Identify the touch points where customers create value, find out what determines that value and whether it varies by customer, identify why customers move from one moment to another. Identify customer touchpoints that create value, integrate records and create customer journeys, measure your revenue at each touchpoint, add everything to that customer's life. Optimove combines predictive customer modeling and advanced multi-channel campaign automation to help businesses maximize customer loyalty, retention, and lifetime value. For example, key determinants of customer value, such as the nature of the relationship, are often not available as properly structured data and therefore are not included in the formula.